there is a global monetary reset underway right now. And Japan and Korea are just the first countries to feel it break. It began a few days ago, and almost nobody explained it to you properly. Japan and South Korea, two of the most important economies on earth, were forced to step into the currency markets together and defend their own money. The yen had fallen to its lowest level in about 40 years. 40 years, and the United States may have quietly stepped in beside them. Now, if you only watched the regular news, you saw a small story about exchange rates, something that sounds boring, something for bankers and traders to worry about. But I have spent 50 years studying how economies actually work, how they rise, how they break, and how the pain always shows up first in the weakest link of the chain before it moves toward the stronger ones. And I'm telling you, this is not a small story. This is the opening move of something much bigger, something that has happened many, many times before across history, and something that will eventually touch your savings, your job, and your country, whether you live in Seoul, in Tokyo, in New York, or anywhere else in the world. So stay with me for the next 30 minutes because I am going to walk you through exactly what is happening, why it is happening right now, why it always happens this way, and what you can actually do about it. Before I go further, I want to say something directly to you. What I am about to teach you is the same framework I have used my entire career to understand economies, to protect capital, and to see these turns coming before most people even notice them. Normally, this kind of thinking is reserved for institutions and for people who pay very large sums of money for this kind of insight. I am giving it to you for free, right here, right now, in plain and simple language. All I ask in return is that you subscribe to this channel before you keep watching. It costs you nothing, it takes 2 seconds, and it means you will not miss what comes next in this story. Because I promise you, this story is only just beginning, and the next chapters are going to matter even more than this one. So let's start with what actually happened, because the details matter here, and most people were only ever shown half of the picture. In the last days of July, Japan's currency, the yen, had weakened to levels not seen in roughly 40 years. When a currency falls that far, that fast, it is not some small technical wobble that traders can shrug off. It means the world is quietly losing confidence in the value of that money relative to everything else. So Japan's authorities stepped directly into the open market and began buying their own currency to prop it back up. Now, by itself, that is not new. Japan has done this kind of thing before more than once, but this time was different because South Korea moved at almost the exact same moment, selling dollars to support its own currency, the won, and reports at the time suggested that the United States may have quietly assisted as well, checking rates in the market, possibly even taking part directly. 3 major economies coordinating on currency defense at basically the same moment. That kind of coordination is rare. It usually only happens when the people running the system are genuinely worried, not just about one currency having a bad week, but about the stability of the wider system underneath it. Now think for a second about why a currency falls that hard in the first place. It falls because too much of it has been created relative to the real demand for holding it, or because interest rates elsewhere make it far more attractive to borrow that currency cheaply and invest the proceeds somewhere else, or because the market simply stops believing that currency will hold its value the way it used to. In Japan's case, All three of these forces have been quietly building for years. Interest rates in Japan stayed near zero for a very long stretch of time, while interest rates almost everywhere else in the world climbed sharply. That gap creates what is called a carry trade, where investors borrow cheap yen and use that borrowed money to buy higher returning assets somewhere else in the world. It works beautifully for a long time until it doesn't. When the yen starts to move sharply in the other direction, all of that borrowed money has to be unwound at once. And that kind of unwinding tends to be violent because everyone tries to get out through the same small door at the same time. So when I look at Japan and Korea right now, I am not looking at two isolated headlines that happen to land in the same week. I am looking at the visible edge of a much larger and much older pattern, one I have studied for most of my life, called the debt cycle. And that pattern never stays confined to one country for very long. It spreads because in today's connected world, money, debt, and confidence all flow across borders like water, finding the lowest point in the room. Now, let me teach you the actual framework, because once you understand it properly, you will never look at financial news the same way again. Economies move in cycles, and there are two you really need to know. There's the short-term debt cycle, which most people have some rough feel for, even without studying it. It usually lasts somewhere around 5 to 10 years. Credit expands, spending grows, the economy heats up, prices rise, and then a central bank raises interest rates to cool things back down. Eventually, there's a slowdown or a recession. Rates come back down again, and the whole cycle repeats. You have personally lived through several of these already, and they feel familiar, almost routine. But underneath all of those smaller cycles, there is a much bigger one running in the background, the long-term debt cycle. And it tends to last something like 50 to 75 years, sometimes even longer. Very few people alive today have lived through one complete cycle from start to finish, which is exactly why very few people recognize it while it's actually happening to them. Let me explain how it works simply. Coming out of a big crisis, something like a major war or a depression, debt levels across a country tend to be low, and that country can borrow and spend for a very long time without much visible consequence. Growth is strong, confidence builds year after year, and slowly, over decades, more and more debt gets piled on top of income and on top of asset values. For a long time, this feels completely fine, even good, because rising debt fuels rising spending, and rising spending looks and feels like real prosperity, but debt is really just spending that has been pulled forward from the future, borrowed against tomorrow to be spent today, and eventually the bill comes due. Interest payments start eating a bigger and bigger share of income. Governments are then forced to choose between a small number of unpleasant options. They can raise taxes, they can cut spending, they can default outright on what they owe, or they can do the fourth thing, which is the path almost every government throughout history eventually chooses, which is to print more money to cover the gap. And when you print enough money relative to the size of the debt, you devalue the currency that the debt is denominated in. That devaluation is really just a slow motion, quiet default, one that never gets called a default in the headlines, but functions exactly like one underneath the surface, because the people who get paid back are getting paid back in money that buys noticeably less than the money they originally lent out. I have studied roughly the last 500 years of monetary history, and I can tell you plainly, this pattern repeats again and again and again. The Dutch guilder was once the dominant reserve currency of the entire world. Then it was the British pound. Then it became the American dollar. Empires rise. They take on debt to fund that rise. That debt eventually outgrows their real ability to pay it back in honest terms, and the currency gets devalued to make the math quietly work again. It has never once, in 500 years of recorded financial history, ended in a fundamentally different way. Not once. So now let's talk about how this actually breaks down in real time mechanically, because this is the part almost nobody bothers to explain. Simply, when a country carries too much debt relative to its income and its central bank keeps interest rates artificially low to make that debt easier to service, cheap money starts leaking out into the rest of the world, searching for better returns elsewhere. That is the carry trade I described a moment ago. Investors borrow in the cheap currency, in this case the yen, and they use that borrowed money to buy stocks, bonds, real estate, and other assets anywhere they can find a higher return, including here in the United States. For years, this quietly inflates asset prices all over the world because there is a steady, dependable river of cheap borrowed money flowing continuously into global markets. It becomes, in a very real and very literal sense, an invisible loan that has helped fund a huge share of the wealth you see sitting in stock markets around the world today. But here is the problem with any loan, hidden or not. Loans eventually get called in when the yen starts to strengthen, or when Japan is forced to raise interest rates to defend its own currency. That carry trade suddenly stops making sense. On paper, investors who borrowed cheap yen now have to pay back a currency that is worth more than it was when they borrowed it. So they scramble to unwind their trades, sell whatever assets they hold, buy back yen, and repay that loan before it becomes even more expensive to do so. When enough people try to do this at the exact same time, you get a very fast, very violent move across markets, the kind that can wipe enormous sums of value off a stock market in a matter of minutes, not months. This is exactly the mechanism behind why a currency intervention in Tokyo can rattle a stock market on the completely opposite side of the planet within the same trading session. It is not a coincidence, and it is not two unrelated stories. It is one connected machine, and the yen happens to sit at one of its single most important pressure points because Japan has for decades been both the world's largest net creditor and one of its most heavily indebted governments. At the very same time, when that specific pressure point moves, the whole machine feels it almost instantly. Let me pause here and give you two quick pieces of history because they will make everything I just said click into place. Go back to Germany in the early 1920s. Germany owed enormous debts after the First World War. Debts it genuinely could not pay back in real terms. So the government printed money to cover the gap, slowly at first, then faster, then absurdly fast. People still remember the stories, workers being paid twice a day because prices doubled by the afternoon, wheelbarrows of cash needed just to buy bread. That is what a currency devaluation looks like at its most extreme end. Most cycles never get anywhere close to that severe, but the direction is always the same, just the speed differs. Now come forward to 1971, right here in the United States. Back then, the dollar was officially tied to gold, meaning any country could, in theory, trade its dollars in for a fixed amount of gold. But America had spent and borrowed more than it could realistically back with the gold it actually held in reserve. So President Nixon simply ended that arrangement, closed what was called the gold window, and the dollar became what is known as a fiat currency, backed by nothing but confidence and government promise. That single decision changed the entire global financial system, and everyone alive today has only ever lived inside the world it created. I bring up both of these examples because they prove something important. Currencies are not permanent, fixed things. They are tools created by people, backed by trust, and that trust gets tested and sometimes broken whenever debt outgrows the real economy's ability to support it. What is happening in Japan and Korea today is a smaller, quieter version of the exact same pressure that broke the German mark in the 1920s and broke the gold-backed dollar in 1971. The scale is different. The underlying mechanism is not. Now, here is the question everyone watching this should be asking, and it's the one most people skip right past. If Japan and Korea are cracking first, who is next? The honest answer is that this was never really about which specific the country goes next. It's about which countries and which currencies are carrying too much debt relative to their income and their real ability to grow, because those are the ones most exposed to this exact same devaluation pressure. Look closely at government debt loads across the developed world right now. Japan's debt relative to the size of its own economy is the highest of any major nation on earth and has been for years. But Japan is far from alone in this. Many Western governments, including the United States itself, have taken on debt loads relative to income that historically have only ever been seen coming out of major wars, except this time it happened gradually, quietly, during peacetime, spread out across decades of ordinary budget deficits. When a government carries that much debt and interest rates rise even a little, the interest payments alone start consuming a bigger and bigger share of that government's income, crowding out spending on everything else it wants or needs to do. At that point, governments face the exact same choice I described a few minutes ago, and history says they almost always choose the path of least immediate political pain, which is to print more money and let the currency quietly absorb the damage over time, rather than raise taxes sharply or cut spending sharply, both of which are painful right away and cost votes immediately. I'm not telling you any of this to scare you. I am telling you this because it is simply the pattern, and once you can see the pattern clearly, you stop being surprised every time it shows up again in a new country wearing a slightly different disguise. The Korean one cracking under pressure, the yen sitting at 40-year lows, the rare coordinated intervention between three major economies. These are symptoms of the same underlying disease, showing up first in the places with the least room left to maneuver. But the disease itself is much bigger than Japan or Korea alone. It is a global debt load that has been quietly building for decades across nearly every major currency on earth. And when confidence starts to crack in one weak link of that chain, capital very quickly starts asking harder questions about all the other links too. That is why this kind of stress rarely stays contained to one place. It moves like a current through connected water, finding every weak point along the way. So, what do you actually do with all of this information? This is the part that matters the most, because understanding a cycle without acting on it is really just trivia. You'll forget by next week. The first thing I would tell you, and this is something I have said for decades now, is do not hold all of your wealth in one single currency, and do not hold it all in cash or in bonds denominated in a currency that a government can simply print more of whenever it comes under pressure. Cash and bonds feel safe because they're stable in nominal terms. The number on your account statement doesn't move around much from day to day, but that stability is an illusion if the actual purchasing power of that currency is being quietly eroded underneath you the entire time. The second thing is to diversify across countries and across different types of assets, not just across different companies inside the same market, owning 10 different stocks in the same country, all priced in the same currency, is not real diversification if that currency itself is the thing genuinely at risk. You want a mix that includes assets outside of your home currency, and you want assets that have historically held their value through periods of currency devaluation, things like gold, which has functioned as a reliable store of value across essentially every civilization in recorded history, precisely because no government anywhere can simply print more of it. The third thing is to think seriously about productive assets, real businesses and investments that generate real earnings and can adjust their prices upward as costs rise, rather than fixed promises to pay you back a fixed number of dollars, yen, or won at some point far in the future. Real productive assets tend to hold up far better through a currency devaluation than fixed income promises ever do, because their earning power can adapt while a fixed promise cannot. And finally, learn to pay attention to the real signals, not the daily noise. A single day's stock market move is noise. A coordinated multi-country currency intervention, a debt-to-income ratio sitting at historic extremes, real interest rates that simply cannot rise without breaking a government's own budget. These are signals. Learn to genuinely tell the difference between the two, and you will find yourself years ahead of almost everyone else still watching headlines without understanding the machine quietly running underneath them. One more thing I want to add here, because people always ask me this next question, and it deserves a real answer. Timing something like this perfectly to the exact week or the exact month is nearly impossible. And honestly, anyone who tells you they can do that reliably is not being straight with you. I have never tried to predict the exact day a cycle turns. What I have tried to do, and what you should try to do, is position yourself so that you are reasonably protected no matter which way it breaks and no matter how fast or slow it happens. That means not making one big dramatic bet on the exact moment of collapse, and instead building a steady, balanced mix of assets across different countries and currencies that you can hold through the noise, the false alarms, and the real turning points alike. It also means staying calm when the headlines get loud, because they will get loud, probably louder than they are right now. Panic is not a strategy, and neither is denial. The people who do best through a cycle like this are rarely the loudest voices online. They are the ones quietly rebalancing, quietly diversifying, and quietly refusing to assume that the way things have worked for the last 40 years is guaranteed to keep working exactly the same way for the next 40. I want to leave you with this thought. What is happening in Japan and Korea right now is not the end of the story. It is only the opening chapter of one. I have watched this exact pattern play out across roughly 500 years of financial history, across different countries, different currencies, and different eras. And it always rhymes, even when the surface details change from one cycle to the next. The people who understand the machine, who see debt cycles for exactly what they are, tend to protect themselves along the way and often find real opportunity right at the start. The people who don't understand it tend to get caught holding the very thing that is quietly losing value, wondering later why their hard-earned savings suddenly buy so much less than they used to. My challenge to you is simple, and I mean this sincerely. Do not wait until this story is splashed across the front page of every newspaper before you start paying attention, because by the time that happens, the smart money has already moved. Go look honestly at how your own savings are actually structured today, right now, and ask yourself whether you are genuinely prepared for a world where a major currency can lose meaningful value in a fairly short period of time. If you found real value in this, share it with one person who needs to hear it. Because the more people who truly understand how this machine works, the fewer people get hurt when it eventually turns. I'll see you in the next one.